Welcome back to Crypto Philly, the podcast where we break down the complex world of cryptocurrency into clear, actionable insights. I'm your host, Sean from CoinFlask. And today we're tackling a topic that every crypto investor must understand: capital gains and losses. Whether you've just bought your first Bitcoin or you've been day trading altcoins for years, knowing how gains and losses work isn't just good for your wallet, it's essential for your tax bill. So let's dive in. First, let's define capital gains and losses into the context of crypto. Whenever you sell, trade, or spend your cryptocurrency, you trigger what's called a taxable event. That means the IRS wants to know, did you make a profit or did you take a loss? A capital gain happens when you sell your crypto for more than what you paid for it. A capital loss is when you sell your crypto for less than what you bought it for. Simple, right? Well, here's where it gets interesting. This applies even if you never cashed out fiat. If you traded Bitcoin for Ethereum, for example, that's a taxable event. The IRS treats it as if you sold your Bitcoin for cash and immediately used that cash to buy Ethereum. So yes, every swap, every sale, every time you use your crypto to buy a cup of coffee, it can be a gain or a loss. Now, let's talk about how long you've held your crypto before selling. This will determine whether your gain or loss is short-term or long-term, and that matters for tax purposes. If you held the asset for less than 1 year, it's a short-term gain, short-term capital gain, taxed like regular income. If you held it for more than 1 year, it's a long-term capital gain, which often comes with a lower tax rate, typically 20, 15, or even 0%, depending on your income. This holding period is a huge deal. Long-term holders usually pay less in taxes than short-term traders. That's why crypto investors opt for the buy and hold strategy. It's not just a belief in the tech, but it's also tax efficient. Now, let's say you had a rough year. Your altcoin bags went down and you sold at a loss. That's not all bad news. Capital losses can offset capital gains, lowering your overall tax liability. For example, you made $5,000 in gains, but lost $3,000 on another trade. Now you only pay tax on the net gain, which would be 5,000 minus 3,000, giving you the net gain of $2,000. If your losses exceed your gains, you can deduct up to $3,000 per year against your regular income. Any remaining losses can be carried forward to future years. This strategy is called tax loss harvesting, and it's perfectly legal. However, be sure to avoid the wash sale rules if they ever do become applicable to crypto. Currently, those rules only apply to stocks, but Congress is discussing on expanding them to other asset classes such as crypto. So be sure to stay up to date with that. Now, to report gains and losses correctly, you'll need solid record keeping. And I cannot stress the importance of how crucial it is to have adequate records of all of your transactions. So I'm going to tell you some things that you need in order to track each of those transactions. First, the date you bought the asset. and then the date that you sold the asset. This determines the length, short-term versus long-term. Then we need to determine the cost basis, or what you paid for that asset at fair market value on the respective given date. Then the sale price. What was the fair market value of that asset on the given date that you decided to sell it? Then we also want to document the gain or loss which was recognized by the transaction. Now, if you're using multiple wallets and exchanges, this can get a little messy. That's where crypto tax software usually comes into play. This software can help pull your wallet and exchange data, calculate gains and losses, and generate IRS-ready tax forms. And yes, come tax time, you will usually report this on Form 8949 and or Schedule D for your U.S. tax return. So let's recap. First, selling, trading, or spending crypto can lead to a gain or a loss. Second, holding over a year can reduce your tax rate. Third, losses can offset gains and even reduce your taxable income. And last, tracking your trades is the key to staying compliant. Understanding capital gains and losses doesn't just keep you out of trouble with the IRS, it can save you real money. So, if you found this episode helpful, share it with a fellow crypto enthusiast and be sure to subscribe. If you got any questions, reach out to us on Twitter at CoinFlask. Or just visit our website, www.cryptophilly.com. So, until next time, stay safe, stay smart, and keep stacking that knowledge.